So now here you'll see it's on preview, but it's not live yet. See the go live button in the top corner there. So now it'll go live. Is the audio streaming yet? Well, let's see what happens here.
So now this is streaming.
Okay, so could you pull up? Oh, you got it there. Great. Add. Hello, we're testing the microphone. All right, looks like it's happening. Okay, if everybody in the back could come up here. Unfortunately, we can't do socializing during the event because the sound travels. They hear it on the live stream. It's a whole thing. Yeah, go for it.
Yo, guys. We're starting in a second. Please make your way to the front. Grab some wine. Cool, we're live. Wow. Silence. Hi, guys. Hi, everyone. Welcome. I'm glad you guys know my name. Hi, welcome to the San Francisco Bitcoin Meetup. Thanks, guys. This edition of the SF Bitcoin Meetup is going to feature a main talk about AtomicSwaps by Portal, by Chandra from Portal. Before we do that, I'm going to introduce Travis, my co-organizer in the meetup, and we're also going to have a lightning talk by John Horvath from, what's your project? Crypto Leprechaun. Right, awesome. Oh my God, I'm getting mixed up. Sorry, before we start, so a little bit about the space. We're Starfish. We are a co-working space and incubator focused on blockchain and emerging technologies. We have over 35 companies based out of the space. We do a lot of events and community building around blockchain and decentralized tech. And we also help companies get off the ground with our mentoring programs and incubator programs. This meetup is made possible thanks to our awesome sponsors at Kraken. Kraken is a top exchange. I'm sure you've heard about it before. And I would like to invite Shimon from Kraken to say a few words about, Kraken, I guess, and why they're supporting the meetup.
Hi guys, great to be here. Really awesome to sponsor this meetup. So basically, Kraken, we're not a decentralized exchange, we're a centralized exchange, but we're super secure. Have been around since 2011, have really low fees, and we're adding more and more features. We have margin trading, we have we have futures, we have a bunch of new features coming up over the next couple of months. So come check us out. Thanks and enjoy the meetup.
Hey, everybody. Thanks for making it out. Oh, yeah. Thanks for making it out. We do these things all the time. We try to make them educational. One of the things we like to do is we do a lightning talk. This is an opportunity for people working on a project to just kind of stand up and chat about it. Just 1 minute, real quick. It's more of a like, hey, if you're interested, come find me later. If you want to do one in the future, just find me or Alicia, and we can sign you up. I believe John? Yeah, we have John doing one tonight, so just a quick round of applause, and let's see what he's working on. We may not be able to get the video. I don't think we'll be able to get the video on the screen. Is that a critical thing?
Oh yeah, it's actually
It was. Let's see what happens. Let's see if this works. Okay, great. Here you go.
Testing. Okay. 1, 2, 1, 2.
Okay, thanks. So my name is John Horvath, and my project is Crypto Leprechaun. And what it is it's a machine learning model that predicts the price of Bitcoin each day after the Bitcoin close. And then what it does, it has an accompanying visualization so you can actually see how successful it was. And so what you see is the candlestick chart. You're all familiar with that, with some volume. And then the purple horizontal lines are actually the Crypto Leprechaun predictions each day. So at 5 p.m., it downloads the closing prices and APIs some other stuff, and then it issues the new prediction. And then at the bottom, you can see, for example, 18 September prediction that's today's prediction, so prediction for tomorrow is 9925. So it's predicting price to go below 10,000. So the model is a LSTM Keras machine learning model, and the one that I'm using had 56% accuracy or hit rate, and I'm getting, when I'm running it live, I'm getting like 52% plus, 53, 54%. And there's one other cool thing I want to show. If you want to see like how well it does in certain regions, it actually tells you what your profitability based on buying or shorting one Bitcoin each day versus a buy and hold strategy down here in the middle. And if you shift the date range slider at the top here, what it just shifts it to the like it can narrow the range, and it'll calculate all that for you. So you can kind of zoom in on areas where it's doing better or worse. So that being said, my background is in finance. I was a Wall Street analyst for about 10 years on the buy and sell side. And what I'm looking for is collaborators that know machine learning, to help improve that side of it. So let me just quickly throw up my contact info. You know what? Actually, if you just come up to me after, I'll give you my card, or my email is john.p.horvath, Horvath, @gmail.com, or I'll be sitting here in the front row. So thanks a lot.
Thank you. All right, while they get the next computer set up, I'll just talk a little bit about our plan for tonight while they get the computer switched over. I was taking care of that. So you probably, as you saw the description, we're doing an event about AtomicSwaps and decentralized exchanges today. It's, obviously really important if you're kind of new to the space. The way you get Bitcoin right now, you go through a centralized exchange. It's just a company, you buy Bitcoin from them. It's just like buying it from a person, but it's this large kind of centralized company. Kraken's even one of our sponsors. And they're huge, they're an exchange. They're huge for getting new people involved. They're really important for getting, that adoption and getting the word out. And you see the buses with the ads on them. That all is generally the exchanges. There's a strong interest though around the idea of Bitcoin's open source. You can launch it yourself. You can run it yourself. Why can't we do the same thing for exchanges? And people have been working on this since as old as Bitcoin's been around. Well, since I guess the second coin was around, just trying how to bridge these things together. And it's generally not really seemed to have gone anywhere if you're really paying attention to space. People announce things, it's really exciting. There's a couple products out there, you can use them, but they don't really have any liquidity or volume. And this is kind of an open question. What are the issues? What are these things? There's a number of them out there now. So today our speaker, Chandra, he's gonna kind of go over the current state of the industry. They're gonna talk about some ideas and just kind of discuss. It's a really great opportunity to ask questions. And yeah, we're just really excited to be able to bring this information to everyone. So I think we're good to go. So without further delay, I would love to bring Chandra up on stage. Big round of applause. Oh. It's all yours.
Thank you, Travis. I'm going to do...
I like your necklace.
Huh?
I like the necklace.
Yes, I was told that if I don't wear this, I don't get to speak at Starfish Mission. And
it's a blockchain.
we are all strong believers in blockchain, so there I am. So, as he introduced me, my name is Chandra. I am the founder of a company called Portal, and our goal is to make Bitcoin unstoppable. And the way we think that can be accomplished is by building products that people love and need, and getting a ton of distribution, meaning a lot of people to use that product. Fortunately for us, the need is widely known and felt and understood. But I'm going to take a little step back and zoom out a little bit, explain why we need to do what we're doing versus like how it works, right? It's easy to get lost in the technical, details of how this works or how that works. The important thing is, why are we even doing the stuff that we're doing? And the number one reason is, we believe that Bitcoin is going to fail, and custodians and centralized exchanges are going to be bringing its demise. So when I say this, a lot of people frown and say, you know what? Centralized exchanges are working fine. They're providing a lot of liquidity for people. There are fiat gateways that help a lot of people come into Bitcoin. Okay, let's accept that argument for a second. The first question is, how do we create a new money, right? If we don't have Bitcoin as money, nothing else would matter. We're all just wasting our time. The easy answer is, for governments, they just need to point a lot of guns at a lot of people and force them to use their central bank printed, hot off the presses fiat money. Or if you live for 1,000 years, you can wait for a commodity with the best monetary properties to evolve into money. If you can't do either, which is the case with Bitcoin, we can't force anybody to use Bitcoin. It's a voluntary system. And we can't wait for too long for the system to strengthen to a point where it can't be stopped. So what can we do? I think I know the secret map of Bitcoin's adoption to becoming a generally accepted medium of exchange or money. And if you're paying attention, that's how it looks. This is a simple log price of Bitcoin on a log scale, charted from about 2010-ish or 11 beginning, when the price still existed in the market, like first existed. And the ups and downs that you see are called price hash rate spirals. The way they work is that some kind of a social or political
Looks like the battery died on that mic, but we have a backup.
Big data this thing. All right. So these price hash rate spirals start with a political or economic trigger that invites a lot of demand of people trying to find out what the hell Bitcoin is, wanting to own some. So given the supply constraints and the quantity constraints of the protocol, it causes an increase. It's fairly obvious, right? You have a relatively rigid supply, increase in demand. Obviously, the price goes up. The second order effect is that it becomes more profitable to mine Bitcoin. And so more hash power joins the network, starts mining, which actually increases the security property of the network itself, because it increases the 51% attack threshold. And so that positive feedback spiral spins and spins until you reach a new equilibrium, then you plateau off and trail off for a little bit, and then the whole thing starts again. That's the technical parlance, but in simple terms, it is basically a speculative cycle. And Bitcoin's path to adoption as money runs through successively larger speculative cycles. Successively larger, emphasis on successively larger. All of those things are powered by trade, obviously. If you don't have an exchange and if you don't have an easy way to buy and sell into Bitcoin, nothing would happen. The problem is, most of that trade today, the engine that powers the adoption curve, runs through centralized exchanges. And I don't hate centralized exchanges. Lots of friends at Kraken, great company, and other centralized exchanges as well. But the problem is, these centralized exchanges that have allowed a lot of people to be exposed to Bitcoin also present a systemic threat to the underlying asset itself. And here's why. If most of the Bitcoins that you and I own are held in an exchange, right? They function as a virtual depository institution. And you and I basically are trading entries in their book or their database. Though your coins can be seized anytime. The exchange may not want to seize them, but they will be under legal, regulatory, and malicious actors like hackers who would want to do it. And the protocol doesn't protect you against that. They can also blacklist and whitelist addresses and arbitrarily or with a good reason decide to block incoming or outgoing transactions. So censorship resistance cannot be guaranteed. So it undermines the essential property of what makes Bitcoin valuable. The second thing is if most of the Bitcoins are held by the centralized entities, they have a lot of economic weight, right? Because there's a lot of transactions. If you look at trade volume versus on-chain transaction volume, they represent a lot of economic weight because they hold a lot of people's Bitcoins. But that contributes very little to the chain security, right? Because not all trade volume translates into transaction volume. And so in that situation, a few players with a lot of economic weight can, and if they're the only ones, or most of the people that are accepting Bitcoin, right, who gets to make the rules? Those that can actually enforce the rules of the protocol, and enforcement only works at the level of acceptance. They can change the protocol. Something like the New York Agreement is more likely to happen the more centralized custody of Bitcoins becomes, and it's also more likely to succeed. That's the academic argument. The simple way to describe this is who the hell likes 17 different exchange, login credentials, two-factor auths, et cetera, et cetera. We need a much simpler interface to be able to keep my coins with no middleman and trade them. So DEXs. DEXs are a hot topic, right? A lot of attempts have been made to create a DEX that is on par with a centralized exchange. You can go the route of a faux DEX, where you create your own chain, which is completely centralized, and then you create your coin, and then you have people buy your coin, and yada, 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 to operate on your DEX. Or you create a true DEX, where the order execution, either the order book, is on-chain or off-chain. If it's on-chain, it's going to suck, because you have to wait for a confirmation cycle for every order to be executed. It has to be replicated on every node, and then miners see them, and they can essentially front-run your orders or cancellations. It just provides a terrible user experience. People remember Ether Delta. It wasn't fun. It failed for different reasons, but the demand was there. It just sucked. The second problem is if you do off-chain order books, you need a secondary system for coordinating the order books across many parties. Like what 0x and IDEX do, they have this thing called relayers, and when you need to incentivize them, you have to create your own coin or protocol. No matter what, DEXs haven't taken off. They have been dead on arrival for a long time, and they've never actually managed to even get to 0.05%. That's being charitable of centralized exchange trade volume. None of them have a good wallet integration. They can't cross chains, because DEXs typically work on Ethereum only. Front running and manipulation, I've already explained. They have a slow and bad user experience, and so they can never match centralized exchanges. So what do we do? How can we fix DEXs? My argument at this stage is that we should not fix DEXs. We should let them go and move on, right? Why the hell do you need a decentralized exchange? What is the property you want from an exchange? You don't care if it's decentralized or what part of it is decentralized. You want a trust-minimized exchange. The problem with centralized exchanges only arises because you and I want to trade. If I give you my coins first, I don't know if you'll give me your coins. Vice versa, same problem applies. That's called a fair swap problem in computer science. And you can't enforce the fairness of a swap without a trusted third party. That's why you have the centralized exchange as the trusted third party that helps facilitate the trade. What if we redefine the problem as, instead of decentralizing the exchange, we want a trust minimized exchange? That actually has a couple of important implications, like, well, don't we need the benefits centralized exchanges provide? What do we get? The orders are fast because they aggregate liquidity, they pool a lot of people, right? It's a classic two-sided marketplace, built-in network effect, more buyers, more sellers, each side benefits the other side. And the network effect locks you in. It provides increased liquidity, speed, and a whole lot of improvements in user experience. We actually want to preserve all of those properties. We just need to add this one little thing called trust minimization in exchange. So, is it possible? It's actually been possible for a long time. But before I get into how this makes exchange unstoppable, I want to ask a question about what is it in Bitcoin today that is unstoppable? Exchanges can obviously be stopped, right? All it takes, I'll give you an example. My favorite example is India. They don't like Bitcoin because it competes with their shitcoin. And so they said, well, we're going to shut it down. And they didn't do anything fancy. They didn't create their own proprietary ASIC and start mining and do a 51% attack. None of that stuff. They didn't do a network level exploit. All they had to do was shut down exchanges. They're like sitting ducks waiting for the taking, right? They shut down the exchanges, gone, Bitcoin trade in India. Second thing is fiat gateways. Obvious choke points can be shut down anytime for any reason. The thing that cannot be shut down, well, I don't like to mention this, but wallets, nobody cares to shut them down because they completely run on the client. They interface directly with the blockchain. You can't stop them. And they're not a money-making business anyway, so no one has even bothered to try that yet. The thing you can't shut down, or at least very hard to shut down, is mining. And why is that? That is because mining actually has these important properties that make it really, really, really hard to shut down. Like, for example, let's say the FINRA or some other alphabet soup agency decides to classify mining under money transmission, right? You're confirming transactions, meaning you're doing something related to money transmission. You need a license to mine. Good fucking luck enforcing that, right? Who are you going to send the subpoena to? And the reason why it doesn't work is because it is an open market. Anybody can join, right? You just need some capital infrastructure. You join the network, download a copy of the blockchain from your peers, you just query, and you start hashing and confirming transactions. Nobody needs to know who you are. Nobody cares about your identity or where you're located. All that matters is that you provide a service that you get paid for. If you don't provide the service, you don't get paid for it, you incur some capital expenses. And the constraints in mining are not political, jurisdictional, or legal. They're purely economic constraints. How much can you buy? Where are you located? What is your energy cost? What are your fixed and variable expenses? And it is openly verifiable. Nobody actually needs to verify how much hash power you have, because I'll find out when I start mining. And you will find out how stupid it is for you to mine if you have a very inefficient ASIC miner. And there, like I said, no identity required. So if people start shutting down mines in one jurisdiction, the hash power is going to migrate somewhere else. That's exactly what happened when Antminer, Bitmain's mines in some unnameable country got shut down. All of those machines got cheaply sold in other markets, and they quickly got to mining again. So how can you make exchange, especially cross-chain exchange, unstoppable? The incentives are there. In fact, the strongest incentive in crypto today, other than mining, is actually exchange. That's where most of the demand is. What is the work that we need to do in cross-chain exchange? The work is not like proof of work that arbitrarily wastes energy to do some things that strengthen the network. This is actually catering to users' demand directly. I have a website. I put up a relay server to broadcast transactions. I connect users, right? I aggregate swap requests, which I construct the order book. I price these swaps fairly, and I'll explain why that matters. I'll explain the options that are included in cross-chain atomic swaps, etc., and on and on and on. That is the work that you do. The reward is the compensation you receive for successfully facilitating a swap. And in the ideal case, these are open markets. Anybody can start doing them, right? Download a copy of the non-custodial exchange client, put up your server, start providing the service. Extraneous stuff like putting up a website, et cetera, attracting users, that's what you get paid for. So you would naturally do it. Nobody needs to know who you are or where you're located. No one needs to know or trust that you're going to run away with their money, because the protocol, if you follow the protocol appropriately, nobody can run away with your money. Just the same way a miner can't take your confirmation request or a transaction and run away with your money. Same thing happens here. If it's not you, somebody else is going to facilitate the swap. It's an open market. That is what makes exchange unstoppable. So the building blocks, most of what I described has been theoretically possible for a while, not really, because some of the problems with the building blocks that were available were really, really tough problems. Like, for example, atomic swap isn't new. Tier Nolan construction dates back to 2013 in Bitcoin Talk forums. And there were some other attempts. I believe Greg Maxwell had one construction before this, which is Alice has some ETH, let's say, and Bob has Bitcoin. Alice generates a random secret, okay, hashes that secret, and locks up the Bitcoin, the ETH that she has, under what we call an HTLC, or a hash time lock contract, with the following conditions. If Bob can reveal the secret that only Alice knows within 2 days, he can spend Alice's ETH to his address. Or after 2 days, Alice can refund her ETH back. In Bitcoin, we call it HTLC. In ETH, we just call it a smart contract. And then she passes the hash of that secret to Bob. Bob takes that secret, takes his Bitcoin, the appropriate, the agreed upon size Bitcoin, locks it. HTLC is a hash time lock contract. And Bob uses the hash of that secret. Yes? Yes. Yeah. Closer? Oh, repeat the question in the mic. Okay. Does Bitcoin or what was the other one you said? Ethereum? Right. Yeah, Bitcoin supports HTLCs. Of course, it appears as a pay-to-script hash. So this works today, has worked for a while actually. And in that HTLC, you put the same hash of the secret that Alice has sent you. You lock up your Bitcoin with the following conditions. Within a day, Alice can reveal her secret and claim your Bitcoin, or after a day, you can refund it, meaning spend it to the address that you own. So the happy path here is that Alice takes your Bitcoin, Bob's Bitcoin, by revealing her secret. That's the only way she can claim it, and she has to do so in 1 day. When she does that, Bob knows the secret. He can take that secret and use that to unlock Alice's Ethereum or Ether to his wallet, basically spend it to his wallet. The swap is executed, right? What makes it atomic, which is indivisible or irreducible? If everybody follows the protocol correctly, once Alice does her stuff of claiming Bob's Bitcoin, there's nothing she can do to stop Bob from claiming her ETH. So the whole transaction gets executed in one piece. Problems. This has been possible, but not practical. Reason why, when I said Bob wants to do this, Alice wants to do this, who the hell is taking care of this important activity of actually facilitating bringing a buyer and a seller together, right? Like that's what an exchange does. It aggregates users. It facilitates pricing, order size, all this other stuff, constructing the order book, etc. Nobody does it. No discussion I've seen of cross-chain swaps or tier Nolan actually talks about facilitation. People wave their hands and say, you know what, some magic happens. Let's talk about the transaction mechanics. That's a problem. That's like saying, I'm building a two-sided marketplace. Some people want something, other people want the same thing. Let's forget about that and let's talk about how to pass money between them, right? No project does that. And tier Nolan swap, no surprise there, does not incentivize facilitation of any third party not involved in the swap. The second problem is Alice, when I said Alice can actually claim Bob's Bitcoin in a day, before a day, she can, but nothing compels her to claim Bob's Bitcoin, right? Alice and Bob agreed on an exchange, they've agreed on a price, they've agreed on an exchange rate. But Alice doesn't have to do anything, really. If the agreed upon price was 1 ETH per Bitcoin, and now the price has moved in a day, and it's now half ETH per Bitcoin, the price moved against the order. So she can simply abort it by doing nothing, and that's called optionality. In this specific case, being able to buy something for a specific price on or before a specific time is called an American call option. And call options, or options in general, have a price. Alice doesn't pay the price. So there is no premium that Alice pays for the privilege of having or owning that option. That's a problem because in liquid markets, inefficiencies like this cannot make, they just can't make markets work. The second problem is after Alice locks up her coins and sends the hash of the secret to Bob, right? Bob is playing coy. He's like, okay, yes, I'll do this exchange with you. I like you. Let's do this. Lock up your coins. And she did for 2 days, after which she can refund. Passes you the hash of the secret. And Bob doesn't do anything because nothing compels him to do anything. He doesn't pay a price, right? He's just MIA. And what can Alice do? She essentially locked up her coins for 2 days. And that's called lockup griefing, because Bob caused a lot of grief to Alice by making her lock up her liquidity for free or kicks. This problem I'm not going to talk about because tier Nolan and AtomicSwaps, there is no UX, okay? So can't expect people to do stuff from their command line and do all of these things. So our goal with Portal Bridge is to make cross-chain atomic swaps as easy as Coinbase. And when we say that, we really mean it, right? The ideal crypto user experience is you have your money, you don't have to maintain 17 different hot wallets, or leave your coins at a whole bunch of different exchanges, lug around your Trezor or other cold storage options whenever you need to do transactions. You have a hot wallet, you have all of your currencies in there, which is also important for some technical reasons I'll get into in a little bit. And if you want to swap an asset to another asset, all you need to do is get the price, see if you like the price, right? You're getting a price feed, you want to change your Bitcoin to Ethereum, and then you request a swap. And that request actually is a partially constructed transaction on whatever chain it is that you have, along with another partially constructed transaction on the chain that you're trying to buy. That gets relayed through the facilitator to every party, seen as an order on the order book. And when that party decides to execute, all they need to do is add their part to the transaction. It gets really technical. I won't get into too much depth, and then broadcast it. So all parties check the transaction to make sure that their public key hash is included in the swap branch, the appropriate branch of the transaction, and then relay it back to the facilitator. So you simply have that. Bob wants to accept it. All he needs to do is accept it, and then you're done. You see some other variables there, like deposit, price, and exchange fee. Exchange fee obviously is the incentive that is built into the swap. It's in band that incentivizes facilitators or the exchanges to facilitate these swaps. The deposit is what prevents Alice from exercising a free option. That is the reclaimable bond that she pays to Bob if she says she's going to do something and doesn't. If she does do that thing, then she can get it back. Same thing for Bob. He needs to pay the exchange fee, and that's what prevents him from griefing or trolling Alice's liquidity. And because most of these communications are just message passing between parties, they're not on-chain transactions, they're partially constructed transactions, encrypted, relayed, you get the speed of a centralized exchange. The only two confirmation cycles you have to wait are requesting the swap, one confirmation cycle, because without an HTLC anchored on layer 1 chain, you have no security, and then withdrawal, which is the same thing as an exchange. So briefly, the architecture is that all of these transactions are anchored in layer 1, but the commitments to these transactions are exercisable in layer 2. Similar to Lightning, similar to some other layer 2 systems that are purpose designed for other applications like Raiden on Ethereum, etc. And because of that, you can actually increase the speed of almost all of these transactions, except the confirmation transaction that anchors your deposit. Everything else happens in layer 2. Security comes from selectively revealing parts of the transaction using a special construction transaction flag called anyone can pay, and there's another flag called sighash single. And then that allows you to make the order book look exactly like a centralized exchange if you want to. Anybody can put in their portion of the input, and once the inputs equal the outputs, it's a valid transaction, can be broadcast on chain. The interesting thing is this supports arbitrarily different number of order types. Actually, this goes into how the deposit construction works, and what you're seeing on the left is the transaction graph. You're seeing these deposits being constructed, the public key hashes being verified, those commitments passed on to layer 2. And then you construct something called an HTLC tree, where you selectively unlock parts of an HTLC, and that's what makes it composable. For example, we want some properties in a construction like this, which is when we say a trade is done, it needs to be done. There can't be any doubts, right? You want a determinism or deterministic execution that can be settled on layer 1 chain. Otherwise, you're talking a whole bunch of gibberish. You're better off doing an ICO. Second thing is you don't want messaging overhead. Only the parties involved in the contract, like buyers and sellers of that specific order or set of orders, will get the messages pertinent to that order. So there is no gossip protocol that broadcasts every message to every participant in the network. And like I said, because the orders are composable, you can support many people joining to fulfill an order, just like a centralized exchange does, right? Partial fills are allowed, limit orders, etc., can easily be done. And multi-party orders, this is actually what allows the orders to be aggregated and give you a centralized, better than centralized exchange user experience. So we call that ZK swap. The thing that I did not talk about is how does that contract execution work? So in this picture, you actually see layer 1, yes, HTLCs are anchored on layer 1. They're passed down to layer 2, where your commitments then become tradable with the same security guarantees that nobody else can spend except parties to that contract, and that too within a specific time lock, anchored in layer 1. The execution part of it, meaning relaying the order book, sorting of the order book according to the price, time, etc. If you wanted to hide that as well, to preserve the privacy of the participants in that order, you could do that. You could blind the price, you could blind order size, etc., but you could still provide a proof that says it was executed according to the rules of the order execution engine. And the proof is guaranteed enough that you can take it back to layer 2, settle it on layer 1, and you'll get your coins. So what are the properties that this gives us? Facilitation, yes, right? If the swap does not get executed, only the success branch of the swap provides revenue for the facilitator. You can call them an exchange, whoever is facilitating swaps, the middleman. No other branch provides them revenue. So what do? I mean, they want to facilitate swaps because they want to make money. You don't need to know who your facilitator is, as long as you follow the protocol correctly. You verify your public key hash is included in the right branch of the transaction, you know, the size is matching, the inputs match, et cetera, et cetera. Everybody, all the 3 parties do that. So you don't need to know who they are. Completely anonymous providers based on Mars can actually start doing this, providing this service on Earth. There'll be some problems with transmission delays and stuff, but that's a joke. That's not a plan in our business. Anybody can provide this service. You don't depend on their identity, off-chain trust, reputation, their regulatory approvals, or anything of that sort, right? Or who is backing them as an investor. None of that matters, just like mining. Who cares who's operating that mining pool? It is trust minimized in the sense that Alice and the facilitator colluding together cannot steal Bob's coins. Alice or Bob and facilitator colluding together cannot also steal Alice's coins. And Alice and Bob can't collude and steal the fee that the exchange is owed or the facilitator is owed. This is important because there is no identity. You don't know who the facilitator is. You don't know who the counterparty is. They may be the same person. They may be different people, right? And the free option problem that I described is there's essentially 2 ways to eliminate the option problem. In cross-chain, this problem actually doesn't exist in layer 2 systems like Lightning because the price of 1 Bitcoin is always going to be 1 Bitcoin. There is no optionality when the price is constant. Cross-chain, because prices fluctuate and because different blockchains don't communicate with each other, right? They don't have magical, some kind of an entanglement. They don't have a mystical oracle in the middle. You cannot eliminate the option problem. But what you can do is you can internalize the cost of the option right into the swap. That's what happens here. Alice actually pays a reclaimable deposit, which is the option price, and therefore all exchanges are fair. So does that mean that Alice now has to run a binomial options pricing tree or understand what the hell Black-Scholes model is or all of that stuff? Like, who does that? I don't think anybody willingly does that except, you know, people on Wall Street. So the beauty of this protocol is that you don't have to care. The facilitator has every incentive to accurately and fairly price the reclaimable deposit or the option. Because if they price it too high, Alice is not going to buy. If they price it too low, Bob is not going to sell or take. Because only a successful swap pays you revenue as a facilitator, you have an incentive to price options fairly based on the size of the asset, the order size, the price, the volatility, etc., the time that you want the option for, meaning the time lock on Alice's contract, etc. So problem solved, right? And it's a specialized function that the facilitator can master. It's not that hard. So we got the properties we wanted, right? It's completely anonymous. It is peer-to-peer. You don't need to trust the other participants in your swap to not run away with your money, because it's never a good security model to say, my security depends on good intentions of good people or good intentions of bad people. A good security model is resistant to bad intentions of bad people, right? So rational economic incentives are what give you security or cost if you do bad things. All right, so what can this infrastructure, this base layer be used for? Obviously, it can be used for cross-chain atomic swaps of different assets. But we're already seeing a lot more financial instruments built on these different blockchains. For example, you have futures, options, which we talked about. You have perpetual swaps, and there's a lot of financial instruments of arbitrary complexity that will be built on top of Bitcoin and other chains. I don't know what they will be. I don't think anybody can predict, but people are creative, and when the incentives exist, they will create them. The thing that they all have in common is that they need a simple, fast, trust minimized trading infrastructure layer, and that's our goal. That's what we've created. So uncensorable money, like Bitcoin, needs unstoppable exchange. Because if you could stop the process of trade or exchange, it'll never get adoption. And we want to move away from this decentralization of exchanges and on to trust minimizing exchange. Because decentralized, there's a lot of experiments, and there's architectural problems that probably cannot be solved without introducing new variables like brand new blockchains, etc. And once you have that, you have all of the real elements for DeFi, right? You want unstoppable finance. How can you do that if your exchanges are choke points, your entities that need to comply with a zillion arbitrary requests, etc. So this is the path to true DeFi, I believe. So that's my talk, and happy to take questions.
Thank you
Yes,
so
sir.
much. Yeah, let me pass the mic around really quick. If you have a question, just raise your hand, and we'll get this on the mic for the live stream.
Yeah, my question is your technology developer friendly?
Yes, absolutely yes. Very developer friendly. Our goal is to actually allow anybody to download the software and get their own non-custodial exchange up and running in under 60 seconds. So, yes, sir.
Yes, hi. From a market perspective, it seems like there's an opportunity for this to be applied to OTC, actually, more effectively than exchanges because of the speed factor, but that's just my first impression.
I am not an expert on the OTC market. A few people who are well-versed in the space have told us that there is an applicability there. I'm looking into it.
Well, the biggest problem in OTC is that nobody wants to reveal their identity, and nobody wants to do a Satoshi test or any of that other stuff. And nobody wants
Aren't
to
they
deposit
required
their
to do KYC AML?
Actually, the fact is that if you can separate the two and keep everything separate, and you can enable an OTC transaction, that will dwarf anything you're going to do trying to deplace massive exchanges. So I would highly recommend looking at OTC for yourself, because one of the things that you solve with this, from what I'm seeing, is you solve what is basically missing in the OTC market, which is that you need somebody in the middle that will neutrally settle the trade without letting either side know anything, and without having to deal with all the other OTC traders and middlemen that are involved in these transactions. So I think that actually is an incredible opportunity for what I've just seen.
Awesome. Thanks a lot. I will actually talk to you, in the networking time. Thank you for that.
Any other questions from the audience?
What is the layer 2 kind of chain or technology you guys are on?
So it's basically we construct something called an HTLC tree, and then you selectively sign parts of transactions that allows you to spend funds pertaining to that part of the contract. So it's similar to Lightning, where you're essentially exchanging signatures on a 2 multisig contract. Here we don't do 2 multisig, except that we do HTLCs. And we call them trees because you can actually calculate how or what branches of the HTLC are likely and what can be matched for other orders and allow other people to actually put their inputs in and join that trade. So it's similar to Lightning, you could say, but it is not Lightning.
Could you talk a little bit more about what it's required to get a coin added? Like what a coin needs to do to be supported or to be
Right. So
included?
right now, we're doing Bitcoin and Ethereum. And Bitcoin-derived chains are easy. Litecoin. Next, we want to do Zcash and Monero, and high-quality public chains.
Does it require anything itself, or just you guys spending the time?
No, nothing. I mean, we're not charging for listing anything like exchanges do. No, we don't do any of that
So
stuff.
I mean, like, do they require some kind of technology? Do they have to support time
Right.
operations?
So
like
if it's a new chain, the chain has to support some operations. Like for example, it has to do SHA-256 and stuff like that. Many chains do it, especially the Bitcoin-derived chains. Ethereum does it. Chains like EOS and Tezos, I don't know, where we haven't looked that far. But our goal was to see where most of the liquidity is, which is between Bitcoin, and Ethereum. And as things change, sure, we'll add more.
I think that's it for audience questions. Thank you again so much for coming out and talking for us tonight. It was super interesting. I like to just, side note, the live stream chat, people they liked it, and it's a very hard audience, the people on the YouTube channel.
Thank you for having me. I'm glad to be here.
Thank you so much.